Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights that'll boost your trading potential. Coming up, markets searching for directions. Investors are weighing mixed signals on growth rates and demand. Now, at the same time, the Dow Transportation stocks are showing renewed momentum, a move that's drawing some fresh attention as a potential read on the broader economy. And from margins to demand to the interest rate backdrop, our trader debaters are standing by. They got the bull and bear cases for U.S. homebuilder Lennar. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Half an hour to the trading day. I don't know if the markets have found their direction yet. The S&P 500 is pretty much just flat right now. We do have some economic data out of the States, delayed jobs reports to the U.S. economy, adding 64,000 positions in November. That's after they lost 105,000 in October. We're playing a bit of catch-up after the government shut down. The jobless rate rose to 4.6%, a little higher than expected by the street. Still not overwhelming odds. I think it's still around a quarter, 27% odds that the Fed will cut again in January. They moved a little bit higher, but as we said, it's a bit mixed. The heat map, if we are going to find some direction, where is it going to be? Maybe it's going to be in the tech stocks. They were all modestly lower at the open right now, at least Nvidia and Google, Oracle, Broadcom popping into positive territory, but nothing all that convincing at the moment, and a lot of red across the rest of the screen. So a bit of a push and pull. Want to check in on Ford after the close yesterday. We got more of their restructuring plans. The shift away from electric vehicles continues. They say they're going to refocus that EV strategy on hybrids, but it's going to come at a charge, a $19.5 billion special charge as part of that shift. But they're actually increasing their adjusted profit forecast for the year. Remember, adjusted profits means all that other stuff I just told you about. Don't have to worry about it when it comes to the adjusted profit line. And PayPal, here's an interesting one here as well. The payments giant is saying it filed for an application to establish PayPal Bank. Their plans there would be a financial institution that would focus on granting loans and offering savings accounts to small businesses. So an interesting move for that name as well. And that's your market update. Joining us for now for a more technical take on what's happening out there in the markets is Hiran Amin and Jason Natick from our TD Direct Investing educational team. Gentlemen, welcome back for another week. Our last Tuesday installment of the show for the year. We always make it a good one. We'll make this an extra good one, and we'll start with silver. You got silver on the mind.
Yeah, I got silver on the docket today, Greg. We're going to start with that, the gray metal. It's obviously had a breakout run ever since the end of the summer. Can't call it quite the poor man's gold anymore. I think, based on where the price is heading, it's formed a new fresh, or I should say it's touching distance within its fresh all-time highs there. Momentum's a little bit stretched, but the trend is still very much intact, and we'll just see that in a moment. A lot of this was driven, precious metals, I'll say as a whole category, was driven more firmer, especially coming out of yesterday. So China had some of its economic data releases on the retail side, a bit softer coming in. There was also very fresh concerns about the property sector. What was it called? State-owned China, their developer, China Vanke, is on the brink of bankruptcy and defaulting on some of their bond payments. So a little bit of shake-up there, which has buoyed up the precious metal space. And silver's demand, being dual nature, precious as well as industrial demand, has outperformed in these sort of boom periods that we have, especially from solar and EVs, have a big use case for it. But what really sets its tempo is gold. Gold really leads the metals complex structure, and we've seen gold also take a rise of it, and silver usually follows the cue right after it. But if we dive into the charts here, I want to just show us the big base breakout that we had over here. So starting with, I'm just looking back into early October where we saw this key level, the 52 level. This was a previous all-time high that it broke through at that 55, which was hit back in 1980. We teased it off, we broke it. It was kind of a fake out and broke back in. And then we did see a clean break, it formed this cup and handle, this long shallowed pattern, and then trying to do a break, and then we saw a clean break with consecutive candles happen here. So now the key zone is the demand zone of 53 to 54.50. So if we do see a little bit of a pullback, we should see it in this level, getting a bit up there. But currently we're very firm. If you look at the moving averages that that I've got. I've got the 21-day in the yellow, I've got the 50 in the blue, and we've got the 150, the longer-term average here. It's quite divergent from the 150-day. It's sitting on the 20-day as its current support level here. We are now sitting at 64.30 as the resistance, overhead resistance there. So that's a level we want to see a break off and then retest over here. The last thing I'll mention, Greg, is we closely monitor the gold to silver ratio. That's a historical measure of whether we see silver being undervalued or gold undervalued. Right now it sits at about 68 or so. Historically, anytime it's above 100, that's a time when silver is considered undervalued. When it's much lower, gold is undervalued. Right now, we're kind of in that medium zone, so there's probably a little bit of pullback that we could see on silver before we get another leg up of demand coming in.
All right, interesting stuff there on silver. No longer the poor man's gold. How about the Dow Transports? What's that telling you?
Yeah, let's talk about the transports. So the transports typically made up of about 20 leading transportation companies, and we're talking from airlines, railroads to freight on the road there. And this is an average that I closely monitor, and this is it's espoused in the Dow theory, and Dow theory, formed by Charles Dow, of course, the founder of the Wall Street Journal. And what it essentially states is that when you have the primary index, which is the Dow Jones Industrials, going up or making all-time highs, you want to see that being corroborated by the transports. Basically, what the industrials make, the transports take. And that's what you want to see. So we've seen the Dow's transportations finally catch up. It's also almost at its all-time highs as well, which is really signaling investor confidence. I mean, there's talks about AI bubbles. Are we hitting market all-time tops? Is the trend going to continue? Certainly by this theory, it is intact that we're going to see it. Now, looking at the chart that I've got pulled up here, I wanted to just show this. We've got a daily chart pulled up here. You can see that it had tested at the earlier in the year, we had hit this sort of 16,900 level. We rejected off of that, and then through the summer, it tried to breach that level. It hasn't been able to do that, and then finally, we did see a clean break. We saw consecutive bullish green candles all throughout November. We're seeing a huge bullish engulfing calendar is what I would say, is where you see this big big candle coming through, and now pushing to that close to its November 2024 all-time highs, which is at 17,735 level, which we've got marked over here. So we could see a little bit of a pullback, but given the year and how it's going to close out, with some of the economic data now well behind us, we had the jobs number come through. We could see it sort of teeter and really touch it. I don't see a breakout happening at the end of this year, but possibly into next year, we could see it as the new shape forms and we get some more data coming in there.
Interesting stuff there. Before the show began, we were talking about some items that we bought, I thought, well ahead of the holiday season back in November, but it was from an international seller. I don't know when it's arriving at all. Maybe before Christmas, maybe after Christmas, but at some point, someone's going to put it in a box and send it to me. You got FedEx.
Oh, we're going to talk FedEx. You're talking more maybe on the industrial scale. We're going to talk on some retail shipping. Well, they do some broader corporate things too, but FedEx, they've got their earnings coming up later this week, Thursday to be exact. Now, typically, they're shipping around 16 million packs a day. That can be used as a bit of a bellwether for the economy as well. How many things are being shipped around the company? That is off 2021 highs where they were up around 18 million packages per day internationally. They do see a kind of an expansion towards the holiday season, both up to anywhere from 5 to 9%. And this quarter specifically for FedEx is big. There was a deal announced back in May with Amazon. UPS stepped out of the space, was exiting that relationship. So FedEx is stepping in to deliver a lot of residential, large package, bulky items. So that's going to be interesting to hear about that from an earnings perspective, how that's kind of continuing to play out. But we all know that the broader economy is shifting towards more e-commerce. FedEx is well documented for their hub and spoke approach with 40 hubs throughout the U.S. So interesting to see how that goes. But one of the things we want to focus on is outside of their domestic is thinking about their international shipping. That makes up, let's see here, about 28% of its overall volumes, but there's been a bit of a mixed message that's coming through. Their economy rates have gone up by 48%. That sounds great. So in 2025, big uptakes in the kind of the lower fares. So that's where your shipping might be stuck in that kind of carousel right now. But their priority shipping is actually seeing decreases of 16%. So we'll have to see kind of where that plays out. Always thinking with the T word in mind, the tariffs, how's that going to be impacting them? But turning to kind of what to expect from the earnings on the top line. line. $3.66 earnings per share, $21 billion in revenue. But what I'm going to be looking at beyond that is that some of their efficiency metrics. We want to see how efficient they are with their dollars, as well as some of their already ongoing cost reduction programs. That's going to be kind of front and center in earnings coming up. But let's jump ourselves into the chart. And FedEx itself has been on a nice run. It has traded off from highs that they experienced late in 2024. Those declines that we saw were kind of measured. I've kind of created, in fact, what ends up being my own kind of personal Fibonacci based on support and resistance over time. So I've drawn those on the chart so we can see as we've kind of bounced off. We had a big kind of price and triple moving average cross. As we approach new price levels, kind of where from in the past behavior can we expect to maybe see a bit of resistance as we've gone on. But in this kind of relatively tight channel that we can see, we've continued to cross through these benchmarks. Every other time in the recent past where it's crossed over 290, we've seen kind of price explosion up towards kind of towards new highs. But that doesn't look to be the case. As if in this particular case, if we zoom in a little closer so we can get a better look at that, we're outside of the upper band on the Keltner channel. So we're kind of beyond kind of the average range that we expected. But also noticing here, it's a little small to see, but I'll kind of describe it for you. There's this big red candle. Once we've broached 280, it says bearish engulfing candle, meaning it's a big red candle where the body is completely larger than the body to the candle to the left, oftentimes signaling a reversal trend. And it's actually caused us to drop kind of in now back retesting the 280 level. And beyond that, if we don't get good earnings, the 240 level has been a real point of inflection for the stock. It's been historic support and resistance. That could be back in play if we're not able to get long-term forecasts, kind of where the market's looking to hear.
Okay, interesting stuff. Thanks for that, gentlemen. If you at home have a question for our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website. Once you're there, you try out the platform risk-free. You just open a practice account by clicking on the Try TD Active Trader button. Then when you're ready to switch to a live account, you just export that workspace and start trading for real. Time now for the main event. That's the trading and the debating. And this week, the stock in the spotlight is Lennar, one of the largest U.S. home builders operating across multiple markets and focused on residential construction and home sales. Before we get started, gentlemen, just want to remind our viewers that the securities and strategies discussed on our show are for educational purposes only and should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk. It may not suit all investors. Significant losses are possible. So it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Now back to the stock of the hour, Lennar. What made you guys pick a home builder to debate?
Greg, you mentioned it off the top. It's I think it's the second largest home builder in the United States market. And the housing market as a whole thematically forms sort of a barometer for the economic health of the country, right? It tends to move in cycles and depends on factors like interest rates, a lot of things happening on that front, and consumer confidence, of course. So, and then you look at the trends right now, data suggests like back in 1984, you had almost half of Americans who were home owners. That number is down to like a third now of 30-year-old Americans, I should say, who own homes. So it's interesting to see how this home builder is navigating through all of those trends and what that'll shape up for the broader economy.
What is it about the swinging of hammers and the buzzing of saws that excites you, Jay?
Yeah, you know what?
Is it just that?
That's right. Maybe get my Tonka trucks out. Maybe get those going a little bit, a little nostalgia. Yeah, like you heard it said, second by home closings, first by revenue in terms of their home builders. Housing just doesn't go out of demand, and somebody's got to build those homes. And there's multi-million-dollar housing deficits. So somebody's got to be there to profit from it. So we'll talk through Lennar.
We all need a roof over our head. All right, let's get some time on the clock. You get the 2.5 minutes to make it your cases. Then we're going to give the boys some time to counter. As always, we draw from a hat, and Hiran has got the bear case. The bear case, right? The bear case. Take it away.
The bear case, yeah. So let's talk about Lennar first, and I'm gonna make this more about the industry as a whole. It's the U.S. home sales have hit their lowest or slowest pace since 2019. and the buying activity by investors in the housing market is at its lowest level in 15 years. So really, this speaks to affordability woes and a supply glut that we're having, and Lennar is going to be front and center as part of that there. You have investors who are being squeezed by high mortgage rates. You have tighter margins, which means there's buyer incentives being chipped away at profits of companies like this, and especially Lennar. And there's three things that I'm going to build my thesis on the bearish case for this. One is pricing pressures. So Lennar's currently basically running like a clearance sale. It's not a sustainable business model. The growth isn't organic. It's a financial fire sale is what they're doing. This is evidenced by the third quarter. They had average sale prices fell 9% year over year to $383,000 in Q3. And these are deep concessions that they're doing when you think about it. They gave equivalent of 14% of rate discounts on home prices, which is worth about $64,000 there, which then brings me to my next point. Severe gross margin compressions is what this follows into. Gross margins plummeted 500 basis points over the quarter from 22.5% to 17.5% in Q3 of 2025. I expect that trend to continue for this Q4 going. And what they're really essentially trying to do is to clear inventory and just have those sales happen on the top line, but they're taking big hits on the bottom line. The third thing I'm going to mention is the legal drama that they find themselves embroiled in. So they're under fire from the Seminole tribe of Florida. So they were, they contracted them to build about, 465 homes worth $300 million. However, they're suing them because after the construction of these homes, they're seeing serious structural issues. We're talking about mold, we're talking about roof replacements, electrical problems. Looks like they're cutting corners just to save a few bucks over here. Let's talk about the charts, though. The charts tell the story that to really wrap this up. You see a significant downtrend, but I just want everyone to focus in the recent 2 weeks price action. Look at these big red candles. We got 3 black crows, which signifies a significant sell-off that's happened. Also, this week running into it, and today with the jobs numbers, you have a significant big bearish candle that's hitting this support level. We have earnings coming out tonight. So this is going to be a key level that we see a breakdown on the Ichimoku clouds that we have. We're still showing bearish sentiment going into the next run into the end of the year there.
That was a pretty bearish take from the bear. What has the bull got for us?
You're laying it on pretty thick over there, Aaron. All right, I like it. Okay, so I also want to look at some macro items here because I believe they really kind of present some tailwinds for the industry, and Lennar's there is well positioned to benefit from here. One being the housing the housing deficit rather that we talked. There's been a severe lack of home building since the Great Financial Crisis. Population growth, household formation, even higher mortgage rates aren't stopping demand. So there's an appetite for more home construction that's out there. And then next thing is that interest rate environment that we're in. We've now seen 3 cuts in a row. More cuts are kind of on the docket for into the new year. So even with modest interest rate declines, we're seeing big increases in terms of purchasing power for folks that are looking to get themselves into new homes. And these rate cuts are disproportionately going to affect new home sales versus existing homes. All right, but let's talk to Lennar. I actually went on their website last night while I was doing some research. It's actually framed really to take the stress and the kind of the dauntingness out of it. It's actually framed much like a retail experience. It's easy to find locations, it's easy to find prices, and there is big discounts that they're offering to some of their employees or some builders, and you can get yourselves into that building avenue really easily. All right, but let's talk about Lennar itself. One of the things that really kind of strikes me that I want to highlight for everybody is that they're vertically integrating in their business, right? So it's not just home building. They've got insurance, they have mortgages. You can even buy Lennar tile to deck out your kitchen just the way that you want. So you're able to capture revenue. You're able to capture, and even if there's demand that's softening from a housing perspective, you have all these other repeatable sources of income that are going to continue to pay benefits. But let's jump ourselves into the chart so we can get a sense. We can see that, it's certainly coming off its high. We're looking at a 3-year weekly chart. Highs were back kind of late 2024. We've kind of pulled off that. But do you want to highlight something here? That we've got that we're looking at. We can see over the longer term chart, the longer term that we can see a pattern play out, the longer it may take to execute. We see a standard kind of cup and handle formation that's building here. If we can get the breakout after we've stopped the downtrend, that's putting us back towards those highs we saw late in 2024. But if we want to even kind of go even shorter term, we've got some near-term pricing that's kind of also showing us some kind of bullish continuations. We've got a series of of bullish triangles that we've got here. What's interesting is oftentimes when you see these downturns out of the incoming trend, if you we'll come back to it later here. I'm going to be polite and respectful of my because of
the bell. Respecting the bell. All right.
Mid-word, not even mid-sentence there. Yeah,
I think part of JSP strategy was like, I
respect you for cutting off.
I got stuff I'm going to say for 3 minutes of back and forth. So let's jump into the 3 minutes of back and forth.
Okay, I'm going to start with cycle vulnerability first of all, because you talked about like these sort of tailwinds, interest rates coming. So let's paint the picture. Look, they've got one interest rate projected for next year to cut, maybe one coming thereafter. What I wanted to say, if you look at the 30-year average mortgage right now, it's hovering around 6.22%. In the U.S., is very much different from than what we have. They do 30-year fixed rates, and then they're locked into it. So it's a big commitment that you have to time with interest rates. Now, this is a little bit lower from what the highs were at 7.8% when we did have an interest rate cycle or hike, but it's roughly in line with where September 2024 is. So the 30 rate isn't going to meaningfully move down. So if you don't have buyers stepping in now, Jay, I doubt you'll have it with another 25 bips cut that might be coming on the cards. Maybe next year.
When you're talking real estate, what's the first rule? Location, location, location. So even if you're seeing slighter demand in certain locations, guess where Lennar is? Lennar's in 30 states and 75 different markets. So even if demand or the buying pressure slows down, they're able to focus their efforts where their customers are. So they've got prime real estate, they've got prime locations. They're able to capitalize and move into those areas.
Well, it's great to have locations, but if you can't move that inventory, what's the point of it? And here's what I wanted to talk about, because when you So I look at D.R. Horton, which is a close competitor to theirs. And when you look at the gross margin compressions, D.R. Horton fared much better through this time. You know, they maintained like a margin of about 22%. They did have a little bit modest reduction year over year, but compared to 500 basis points, means they're really deep discounting to even get a lot of that inventory moved off the shelves. The other thing I wanted to mention is we're looking for stocks. And when you think about, okay, the ultimate, sort of these tailwinds that you mentioned, we've got a short-term economic buzzsaw right now. And that is the definition of wishful investing if you're going to rely on those tailwinds. When you look at forward projections, analysts are saying for 2026, 2027, they're looking at 8.5% reduction in their EPS expectations for profit. So they don't see them improving going into next year, even with these interest rate markdowns.
Well, here's something that's being well received by the market. It's a shift to what's called a strategic shift towards an asset-light model. It's one of their competitors, NVR, has already made this shift. It's where the home builders are less focused on actually buying the land and focusing on producing homes. So this is something that D.R. Horton, you mentioned, is not doing this. They're more asset heavy in terms of their. So this is an opportunity to reduce cyclicality, reduce risk, reduce outlay of costs up front. They've even been able to spin off a lot of their land into its own business. So this is something that.
I'm glad you mentioned that, because I have it in my point, because that's basically a buzzword for being late to the party, this asset light strategy that they have. It's a risk mitigation strategy after the risk has already appeared in this case. It doesn't insulate them from the fundamental issue, which is affordability. So no matter how much land they own, if the consumer can't afford the mortgage payments, Lennar's left holding the bag.
But here's what you can't deny. Last 3 quarters in a row of accelerating new home orders. So it's happening.
You had to get that last
one. Yeah, to rest on those laurels.
We'll allow it.
I was polite the first time. It's
a bit like a legal drum. I'll allow it, but you're skating on thin ice. Nice debate, gentlemen. Let's go into the platform. Let's talk about possible bull and bear strategies. I guess we started off bearish, so why don't we start off with the possible bear strategy options?
Yeah, let's talk through this one, Greg. So if someone is of a bearish inclination, one possible strategy you could look at going into this earnings print is a strategy that's called the butterfly put spread. Now, it is a net long strategy, so we are paying a debit for this trade. And there's a few reasons why going net long, especially around this time, makes sense. One, when you look at Lennar's volatility profile, implied volatility profile, it's on the lower end compared to its historically. So it's about 41%, which usually means when volatility is low, it's more sort of conducive to go long or buyer of options. You add the VIX into the mix as well. VIX is sitting kind of not quite at the lows, but it's sitting about the 16 level. Typically, when you're looking to sell options, you want to be at the higher, breaking over the higher 20 level. So coming back to this, what I have on the charts here is the strategy put out for you. So we are looking for a directional or downside movement by putting on the strategy. The one other thing to know with certain securities, and Lennar in particular, is that it's a little bit illiquid because you do have quite a bit of wide spreads depending on which strikes you end up doing. So by doing this strategy where we're looking to sell options, we're mitigating some of that liquidity issue that might come up there. So we're looking to buy the 120 strike put. This is pretty much kind of right on the nose or right at the money. It's kind of peeled back off of that today. And we're looking to identify the next possible level that we could see a support at, which is down to the 105 level with a little bit of a buffer. So we're going 15 wide on the spread. Now here's what makes it a butterfly. We're selling 2 contracts on the 105, and we're buying one further out equidistant, so again 15 points out, on the 90 strike put. So essentially what we wanted to happen is we need the stock to fall. We need it to fall beyond our break-even price, which currently sits at $116.50. So in other words, I'm spending $3.50 to put this trade on. That's my outlay, capital outlay, $350 on a single contract. And if it breaks beyond this level, then we start making a profit. We realize our max profit if it just kind of takes a breather at the 105 level by our expiry date there. So this is kind of the trade you can possibly look at there.
As you said, you laid out $350. So that's your max loss in this trade, and I think you had a max profit over $1,100 in this.
Yeah, $1,150. So you got it right. So if the trade doesn't go in our direction that we wanted to, then we lose what we spent. In this case, $350. Max profit is essentially the spread, which is $15 is what we have. Subtracting what we paid for it, $350, which equals $1,150. Hopefully my maths over there.
I gotta trust your math over mine. Jason, how could a bull play it?
All right, so Heron laid out a nice case that kind of lends into my, just in a slightly different direction around, when volatilities are low, when they're typically going to expand. We're looking at volatility at the stock level and on the VIX level. If we can get volatility expansion, even without substantial price increases, your premiums are going to go up, and that could be a case to profit if you're long an option. So in this particular trade, we're going to get to the chart in just a second to talk about breakouts to where I've chosen a strike price, but this is going to be all around, just keeping it simple, buying a long call and then hoping to see further expansion in prices and volatility over time to generate some profit. So in this particular case, going to the chart, proposing buying a $130 call, but with a little bit of time on this one as well, taking us out into March. Right now, that's trading around $5. But before we get to that decision-making process, kind of bringing up the chart that we had a little earlier, we had a triangle that we did break out from the triangle, but we then have now retested, but have held onto the support line around the $118 level. We've got another triangle that forms subsequently after it based on similar movements. If we can see breakout above that, we have a gap that doesn't look to, that's not really providing resistance over the near term. We can get positive, it could potentially get positive momentum. But thinking about kind of where, what's led me to the chart, we have, no pattern is complete until it's confirmed, and it's something we've preached about on this show before. But we've got a triple bottom pattern forming that if we can get breakout above our 130 strike, that's going to move us back towards the measured move up towards highs that have taken place earlier in the year. With this particular case, it's a $130 call that's going to cost us about $5 to get ourselves into, meaning our break even is going to be around 135, and if we can get a measured move that's going to be $10 more than that, we've got time for us to reduce costs as opposed to stock ownership. If we can achieve positive momentum, we're a winner in ourselves by laying out less money up front, but it's giving ourselves opportunity to run and capture profits beyond this in this particular case.
So I guess we got the max loss on the screen there. I have to do this because I need those old school vibes, like I'm playing tennis in the 1970s to read the screen from this distance.
I gotcha.
But to the upside, I guess if your call, your upside is...
Yeah, upside's the same kind of risk profit profile of buying a stock. So your unlimited gains, the higher the stock goes, the more you're going to make. Premiums have come down slightly since when I did this chart. Right now it's $5 is what it's going to get in, or $500 a contract. So that would be, and this is a directional trade. If it doesn't go up, you're not making money. You're going to need to manage yourself out to help mitigate some of that loss. But knowing that if you are wrong and are asleep at the wheel, what you pay to get into it is the most you're going to lose.
All right, people don't realize about the studio because we hide them. Say the lights are very bright to make us look so pretty. So it's a trade-off, right? I can't see what I'm doing, but hopefully
you got to look good.
But hopefully I look good. It's better to look good
than
to see good, they say. Thanks, gentlemen, for laying out the bull and bear cases for Lennar. Just a reminder to our viewers that this debate was for educational purposes and does not reflect our personal opinions about the stock. Before we move on, Jason, you're going to talk about customizing trend lines.
Yeah, speaking of looking good, I want to help everybody make the charts look good here. That's what this is all about. So we're going to go through a few of the kind of functions that can really set your charts apart if you want to get more information or just want to make them look nice and pretty. So let's jump in and take a look. All right, before we get ourselves into drawing the trend line, I want to highlight for everybody kind of maybe a bit of a hidden feature. On the left-hand side, you see this little magnet. We call this magnet mode. This allows for folks that are looking to draw really precise trend lines. This is going to, once I turn on magnet mode and I go ahead and select my trend line, once I activate it, noticing here, it's actually going to be, you'll see it's sticky towards the nearest open, high, low, close. So if you're drawing specific lines, this allows you to be very accurate and very detailed. We're just on our 3-year weekly chart, one we were looking at earlier. All right, let's get that line on the chart so we can get on editing it here. Now that we've got the line on place, this is default color, default thickness. Noticing there's this editing window that's going to be up in the top. It is movable. If you can certainly move it around, so that's going to be up to you. You can first start by choosing colors. Maybe we want to choose something nice and bright and yellow. Next one over is your ability to choose different thicknesses. Let's say we move this and make it a little thicker. You can also go dash, so you can really kind of make things stand out and make things pop. All right, the next one up is this little gear off here to the right. This is where kind of a lot of the magic hits the road. It's where you don't need to do some manual calculations. You can put on data right on your chart so it pops off for you here. What I like to look at here is under this measure box, you can show percent change. We got show the change. You can even count the number of bars it took for that line to take place. But let's just choose one here and get it added on. If we just show the change, if we close that up, look at right there in the middle, we can see on this haphazard line that I drew on the chart, we're up just a shade over $20. So it's meant to take a lot of the guesswork out. It's looking the way I look. It look good, feel good, if is what the kids are saying. And then you've got the information that's there at a glance, ready for you to interpret and get right back to your trade.
All right, interesting stuff. If you at home have a question about the TD Active Trader platform, or if there's a stock you want to see these two guys go head-to-head on, send us an email at td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. If you scroll down, you're going to find a tab that says Join a Live Masterclass this Wednesday, 2 p.m. Our very own Brian Rogers is hosting an interactive session about TD Active Trader, which will explore all the main features the platform has to offer. Registration is required, and it's open now. Before we wrap up the show, some of the other key things investors are focused on for the rest of the trading week. What is on the radar here?
There's quite a bit. This is the last full week of the year with data that's going to come out, Greg. We had the big one come out today. That was the non-farm payrolls. This is a combo between October and November. They gave the October jobs numbers. Came in very, very light, actually negative, in fact. I think the number was reported at 105,000. And then November made a complete turnaround with 64,000 positive. Now, I'll quote Jerome Powell. Fed Chair Powell said, they are looking at this with somewhat of a skeptical eye when you see those numbers. But it's just something that's going to reinforce how the Fed is going to weigh itself more and lean against the jobs numbers. You have CPI that's going to be released on Thursday as well. Expectation is for it to just go up about 10 basis points from a year ago. 3% was in September, so 3.1 is the expectation, unless it's a big miss that might ruffle some feathers again there. So that's one to keep an eye out. Then we got central bank bonanza. I know we had the Fed happen last week, but across the globe, you got ECB reporting on Thursday. The BOE, Bank of England, they're expecting to do a 25 basis cut. The big one I'm going to keep an eye on is on Friday, BOJ, Bank of Japan. They're expecting to hike up another 25 basis points. They're currently their rate sits at 0.5%, the lowest. This is what started the yen being a cheap currency source. And if they start doing these hikes, will it make the yen expensive, and could we see a yen carry trade? The last thing that's, if it's reminiscent for me to mention since we talk about options on the show, is Triple Witching Friday. We got Freaky Friday coming up, December 19th, the last one for the year. So just be on the lookout. This is where you have a futures, index options, and then equity options all expiring on the same day, so it adds a little bit more volatility. And then on Thursday, I'm going to turn back to equity space. I'm looking at Nike. So we're going to look at the footwear. They're reporting earnings for Q2 2026. Expectation is 38 cents on the bottom line. That's going to mark a 52% decline year over year, and 12.2 billion on the revenue, which is about 1.7% decline on a year over year basis. But the key things that investors are going to be focused on is, one is the China demand. We've seen slow retail sales coming out of China. that is impacting Nike. They have about 13% of total Nike's revenue comes from China, but it makes up 40% of the EBIT, which is an important number there. So it's not an immaterial region, even though when you look at the sales. The other thing is CEO Elliott Hill's Win Now strategy that they came out with, realigning the company's financing for aggressive direct-to-consumer campaign. They've brought sharp losses this year, so what's the turnaround going to be with that? And there's been a bit of reshuffling at the C-suite level. They've had a change in the CEO and leadership to more align it with someone who has experience with operational execution. So what that's going to shake out with. Coming to the charts, though, we see the story being corroborated. Going through a lot of these changes, we see this big downtrend that's formed with Nike since August over here. We did see a little bit of a breakdown, kind of starting to form like an ascending triangle at this level over here. We did break through this key 65 to 66, which is now sitting as a support level right now. So the key is it has to keep holding this level. It is well below the 150-day moving average right now. Coming into this earnings print on Thursday, market's expected move is about $5.40 on either the top or the bottom side over here. So that means it could either get back to the 73.90 if they really wow the street, or we could see it test the 62.30, which is the previous lows over here. Keep in mind, it's still on an overall long-term downtrend. You can see the highs that have connected over here. So we're looking at really the top side at 77 in a best-case scenario going into the end of the year here. So want to keep an eye on.
Interesting stuff there. People think my choice of snack food at night is strange because I'm a cereal guy.
Yeah.
If I'm feeling a little peckish around 9:30 like I was last night, I had a bowl of Cheerios. You got General Mills.
Yeah, we got General Mills, and you know what, cereals.
Am I a weirdo?
No, you're not.
That's my choice as well.
Are the weirdos because cereal's a big choice with the teenagers at home and for me as well. So for sure. But yeah, we did cover General Mills actually back in June. So it's nice to do kind of a little check-in to see how things are going. And if we're talking cereal, they're huge, obviously in the place, but they've actually just released a Grinch cereal for the holiday season. So interesting to see how that plays out if it's flying off the shelves. But I know investors will be looking at their earnings that's coming up actually tomorrow, hoping that the revenues aren't two sizes too small. So that'll be there. But with nice, yeah, for sure. But with successive rate cuts, it's actually an interesting fact here. We know that the rate cuts happen with the Fed 3 different times. What's kind of played out in terms of the S&P 500? There's now only 58 companies that have yields larger than the 10-year Treasury bond. So it'd be up to you to where you put your money. But if the market risk is there, then maybe the 10-year might work your way. But there's other companies that can generate some of that income, and General Mills happens to be one of them. Their yields right now a shade over 5.2% with a manageable free cash flow payout of around 58%. So, but turning to kind of their earnings, and this maybe not play so well here in terms of their free cash flow, but their expected revenues are going to be down by about 9%, as well as the earnings per share is going to be down to $1.02, which is down about 27%. And this is off of a really strong Q1 in 2025, so it'll be interesting to see how the market's going to react. And there's things that are going to be kind of the listing for, and from we're talking from an earnings perspective, is not only the tariffs and the retail strength, but it's going to be like it's not just you. There's other people are shifting away from the market. So we're looking to see how that is going to be, what consumer spending preferences are going to be. But let's jump ourselves into the chart. I've got General Mills kind of outlaid with the SPX. We can see the SPX is significantly outplaying the GIS. It's kind of running counter to what we've seen in the broader market. The stock is down 50% over the course of the last 2 years. So we've got a lot. We saw a double top kind of form midway through, midway through 2024, and that played out. We even saw the measured move on that particular actually get blown right through, and we've seen a very steep bear trend that's been trading down. We've kind of rejected off the top end of that trend as we get into earnings, but it's not all negative here. We do see a really short-term head and shoulders pattern that's formed that we can kind of, if we get a positive surprise from an earnings perspective, can push it back towards the 200-day moving average, which is going to be a key level that's going to be built. But there's a lot of negative momentum that's building up here, so it's going to take maybe a little prize in the cereal box from the earnings to see if we can get some investors back on board with some confidence coming up into the new year.
Great stuff as always, guys. This is our last trading debating session of 2025. I think a round of applause for these guys. There's no one in the studio here, so I'll do it.
Yeah, we'll clap for ourselves here.
You guys did such a great job. We'll be back in 2026. We'll be back on Thursday, though, here in an eye for the Thursday installment of the show. But this is it for the trading debating for this week. As always, investors should perform their own due diligence before engaging in trading. Thanks for watching.